Okay, welcome back, everybody, to the second half of our afternoon. So what happens from now is our second panel will take place. We've taken care of the insurance part. Now we look to the progress towards a sustainable economy. After that, then Jean will give his keynote, and then after that, there's drinks. So I'd just like to introduce our panel. So, first of all, we have Katheline Schubert, who's a professor of economics at the University Paris Panthéon-Sorbonne, and also research fellow at CEPR. Gilles Moëc, who's the chief economist for AXA Group and head of research. Maud Abdelli, who is the global sustainable finance lead for the Worldwide Fund for Nature. And Olivier Rousseau, who is the chairman of the Pension Agency of Georgia. So, if you could maybe give some applause for the panel. So we'll be talking today about how to finance the transition to a greener economy. We have a need to get to net zero, and that doesn't come for free. But we have to work out how to do that, and it's clear that we haven't as yet solved that problem. Kathleen, first of all, can I start with you to actually find out what the size of the problem is? What is the need for investment to get to net zero, and what sort of investment?
Yeah, so maybe first I can define what is the investment gap. So how it is measured? It is measured by looking at the investment we do now, for instance, in France or at the European level, for the energy transition. So it's investment in decarbonized electricity generation, electricity grid, batteries, also investments for transport, clean transport, and clean buildings, and so on. So we measure this investment today, and we look at scenarios that are made by different institutions, like, for instance, the European Commission, giving us what is needed to achieve our objective, maybe at the European level. So the objective in 2030, the objective of zero net emission in 2050. So what is needed in these areas to achieve these objectives? So this will give you volumes of additional investment that is needed. And then we must multiply by prices to obtain the data in value. This is a bit more tricky because these prices, they are estimates of costs, actually, costs of technologies that do not necessarily exist, and we do not necessarily know how these costs are going to evolve. Take the example, for instance, of batteries. To deal with intermittency, you don't know very well what will be the cost. So these are just estimates. But what is striking is that the estimates that are given by different institutions are very, very similar. So basically, it's huge. It's a huge amount of money that we need every year. For instance, the estimates by the European Commission that were released, not the European Commission, but I4C, an independent institute, that were done for Europe. They say that investment needs are, deficit is something like 2.6% of GDP. We have to invest additional investment of 2.6% of GDP each year, every year, from now to 2030 and 2050. So it's huge. I said something wrong. Caveat, it's not additional investment. In this data, they are not additional. In this data, you don't take into account the fact that if you invest in an electric vehicle, you are not going to buy an internal combustion engine car. Okay, so it's not additional, it's gross investment, not taking into account the investments in fossil that are not going to be made because we do these alternative investments. This is this is the caveat we can put. That's it for the definition. Of course, it doesn't say anything about the profitability of these investments. Are they going to be profitable, or is it just money that we throw away just to achieve the climate objective? So this is, of course, very important, because if these investments are going to be profitable, they are going to be made by firms. If they are not, the government or climate policy has to enter to make them happen.
So we're talking about quite an extraordinary amount of money. Gilles, at this point, is that how much of that falls on the private sector to invest? How much missing investment is there from the private sector in that?
Well, quite a bit, and for me, it's quite obvious that the private sector will have to probably shoulder at least half, and probably more than half of the necessary investment, at least in Europe. There's one very strong reason for that, which is that this huge demand for new investment is coming at a time when fiscal rooms for maneuver, especially in Europe, are massively constrained. If you take on board the fact that if we need to face a steep increase in the quantum of investment for any given level of savings, it means that the natural interest rate probably needs to rise. I guess Jean will make the point later, or he made the point earlier. And if interest rates rise as a consequence as well of the need to fund the transition, then governments will be even more constrained. So yes, the private sector needs to play a big role. So the next question becomes, is the private sector, the financial industry, ready to play this role? And I think the answer to this is absolutely yes, for strong, nice, and less moral reasons. First of all, if you are an asset owner, and I will take the example of my company, it's an insurance company that happens also to manage savings. As an insurance company, this was the point made in the previous conversation, it's our vested interest to actually contribute as much as we can to the transition to net zero. Second, as a manager of savings, I think it's simply part of our fiduciary duty to take on board sustainability in our investment decisions. If you're in the US, especially in a few southern states in the US, you want to take a very, very narrow definition of fiduciary duty. You're going to say, okay, it's all about short-term, purely financial returns. I think that the only reasonable definition of fiduciary duty, if you are an asset manager, is to say that we need to take on board the level of risk in the equation. And sustainability has to be envisaged from a risk point of view as well. What we want to protect our clients from is the risk of being faced with strained assets in their portfolios. Or we don't want our clients to have to, in the end, pay the price of a rise in the cost of carbon. If we actually end up having a carbon tax, it will obviously change the profitability profiles of the companies in which we invest, depending on their carbon intensity. And that gets me to my final point. I think saying that governments alone won't be able to fund the entirety of the transition and that the private sector needs to pick up the tab, so to speak, doesn't mean that governments have no role to play in how the private sector is going to contribute. And on this, I think a key issue, a key input, is to give us visibility on policies. That is absolutely key. I will take two examples on that. One, it's the price of carbon. Yes, I know economists spend their time talking about this, but having visibility on the price of carbon, not just tomorrow, but in 5 or 10, 15 years, this is what will make it possible for us to tell our clients, okay, this is likely to be the financial performance you can expect, because we will treat the price of carbon just as any input in the financial analysis of any asset. We need visibility on this, and the very second last example, it's well known in France, the debate at the moment on the decisions which were made at the European level on the transition of the car industry. I'm not a specialist of the car industry. I don't know if it's good or bad, the decisions that we made on the speed at which we forced the end of the combustion engine. The only thing I know is that you've got billions of euros and dollars which have already been invested on the basis that there's going to be a certain schedule, a certain sequence for the exit of the combustion engines. You cannot change the rules of the game all the time, and having this sort of visibility is something we absolutely need from governments.
Thanks. Maud, while we're still defining our terms, I note that we've dropped straight into talking about carbon. Does this drive you a bit crazy?
Yeah, I mean, I must admit a bit, but I mean, my own frustration is not so important. But I just want to really maybe keep a step back, take a step back, and really recall that we will not deliver our net zero goal if we are not preoccupied about the state of nature and nature conservation. As most of you may know, already climate change and nature loss are really interacting, and it will be really, really a shame to look only at climate. Why? Because obviously nature is our best ally to mitigate climate change, and nature conservation also needs a lot of investment. And let me give you maybe one example here. So it's true that we need, for example, to meet our Paris aligned agreement, that we need a rise in our investment in clean energy to 4.5 trillion a year by 2030. But we also need 7.4 trillion investment in dollars to be invested between now and 2030 in the 9 key nature-related SDG targets, and we need also between 100 and 200 billion dollars a year to meet the global biodiversity goal of the Convention on Biological Diversity. So it means that if we only invest in climate change, mitigation and adaptation, we may also lose the battle, because we will lose one of the best tools we have at hand, and that is already there, that is nature, to mitigate climate change as well.
Olivier, we know that there is a huge gap between what's being invested now and what we need. Gilles said that one of the problems is the clarity on policy. How much of the gap is explained by that, in your opinion?
I think the situation is very different when you look at the Western world, when you look at both sides of the Atlantic, and when you look at the situation in the developing countries. And by the way, developing countries, we must absolutely make a caveat for the Gulf countries, which kind of are the winners in both cases, with the oil-based world and with the new energies, the renewables. But so it's a very diverse picture. I mean, I'm not coming back to the figures that have been articulated. The speakers have been prudent in saying that they're not rock solid. You have conventions, you don't have all the data available, but indeed, there is more investment to be deployed, if only because for climate reasons, we have decided, and for good reasons, that a lot of the capital stock is made obsolescent. Suddenly we say, no, it's no longer good. It's physically still able to produce, but we cannot rely on it for a long time. So that's one thing. The investment needs are huge. Now the resources, the financing resources, they're essentially there. The macroeconomic picture, at the moment, you would say, well, it's slightly deflationary. Look at China. China could direct huge amounts of funds towards accelerating, speeding up the build-up of solutions for the climate. They have great ambitions in Africa. I think they are mostly driven by geopolitical considerations. But anyway, there is a lot of money. We were saying Europe. Europe has a saving surplus of about 2% of its GDP. We said a minute ago, 2.6% per annum is the amount of investment that needs to be channeled towards the transition. And this figure is a slightly bigger, or potentially very much bigger than what is needed, because we have the old investments that will no longer need to be done. So we have a solution in Europe. We can perfectly do our climate transition. It's just a matter of channeling the funds. Of course, today, the US financial markets are such a great attraction. At this stage, I will finish by saying that a lot of the problem with the money not going to Africa, say, but we can say that for the rest of the developing world, is the perception of political risk. And that's where the multilateral development banks play a crucial role. You feel naked if you go invest in one particular, at random, choose at random, in Africa, if you are just one private entity. But if you have the World Bank or the EBRD or the African Development Bank, that's a different game.
Excellent. We're gonna pick up on that development point a little bit later. First of all, Gilles, I'd like to ask you. You've been talking about the frustrations of being able to commit investments. Has it been, for investors, is it a huge problem at the moment that the commitments from governments seem to not be as solid as they were a few years ago, not least because of the political turmoil that we've got going on at the moment?
I think it's fair to say that there's a wobble. You could say that maybe we hit peak ESG enthusiasm about, I would say, 5 years ago. Yep. When the entire planet was more or less converging towards a greater awareness of the problem, and there was more than awareness of the problem. There was a convergence on the solutions, and this has become more complicated. Why? Because we're discovering, and that gets us back to Kathleen's point on the amount of investment that's needed. There's a cost. I think there was a tendency to try to sell the transition as a sort of extraordinarily happy, nice, and cost-free endeavor. It's not. Sorry, but it comes with a price tag. I still believe, and there's trillion of papers of evidence on this, that the cost of dealing with the transition and financing the transition is much lower than the cost of allowing global warming or the destruction of nature to continue unabated. But yes, it comes with a cost, and with the realization of the cost, it becomes more complicated to get the level of commitment from the governments. And the elephant in the room is obviously the dividing line and the widening gap, I would say, between the US and Europe on this issue. We'll see, obviously, what kind of commitments, residual commitments we get from the US in 2025 after something that's going to happen in November. But it's clear that there's a gap. I don't think, however, that we should be too negative and too gloomy about this. Every 2 years, I think, the European Investment Bank conducts a poll in Europe, but also in the US and in China, asking regular citizens, what do you think are the main challenges for your country in the next 5 to 10 years? And in the last batch, what was interesting is that you had the same percentage of respondents saying that global warming is a big challenge for their country in the US and in Europe. And actually, when you ask people, are you willing to pay yourself extra for the transition, the percentage of people responding yes was higher in the US than in Europe. Possibly because in the US they haven't really started to pay, whereas we're a bit more advanced. But there's a popular commitment, which I think is still there, which can be tapped, even if I agree that the last, let's say, 2 to 3 years, there's a sense of loss of momentum.
Katheline, we can't let this go much further without mentioning a carbon tax. And is it... does it hold back investment and progress towards this transition that there is so much dispute over what the carbon tax should be internationally?
First, I would like to say that I'm a bit less optimistic than you are, because, for instance, in France, in the public debate, in the debate before the elections, no party ever talked about climate change. It is not in the debate. It was not in the debate, and it is not specific to France. It is the same. I was in Austria last week. It is the same in Austria. Nobody talks about climate change. Everybody talks about the price of energy. Actually, people are interested in having the lowest price of energy possible. It makes sense because the high price of energy is something that is bad for their for their purchasing power, but in another way, we climate economists would like to increase the price of energy, and in particular the price of fossil energy, because we would like to expel this fossil energy from the market. So there is a big tension here. So I think, coming back to the carbon tax, I think that governments clearly prefer regulations and prefer subsidies, and firms also prefer subsidy, of course. But nobody really, except economists, nobody really takes into account the fact that these subsidies have to be financed by maybe other taxes, or they are not for free. And the same with regulations. Regulations are at least as regressive as the carbon tax is, and they are also costly for people that have to comply with these regulations. So I think that the debate on the carbon pricing and versus regulation and subsidies is very, very confused, and this is a problem. And from an international perspective, probably a uniform carbon tax across countries would be a perfect solution, but economic theory tells you that it is a good solution only if it can be coupled with transfers, okay, transfers from rich countries to poor countries. And again, it's a bit unlikely that these transfers are going to occur easily in the near future.
Maud, is information about nature loss, biodiversity loss, is it harder to quantify, certainly in a way that when you communicate that to investors, that makes sense to them to motivate their actions?
Well, of course, it's true that nature-related information are. Understanding nature is a bit more complex than climate. You don't have one unique metric. You will need to really understand the risk locally in specific geography. But still, there have been a lot of improvement on having biodiversity-related data and also tools to assess different dependency and impact some companies may have on nature. So it is improving. And I will say that also sometimes nature seems to be a too big topic for people to really understand. So at least in WWF, we really think that we should really focus on the common drivers of nature loss and climate change. And what are those common drivers? They are quite simple. No, we have to fight deforestation. We have to make sure that we will have still fresh water to drink later. We have to combat pollution, obviously, and so on. And if we focus on those drivers, then the assessment of the status of nature, so the assessment of the status of forest, if we take the example of deforestation, is much more simple. And for deforestation, in fact, we already have a lot of data. We know the key sector of activity to focus on, like forestry, obviously, and agriculture. We know perfectly what are the main protected area to preserve, and we also know where companies are operating. So I would say that investors could really take action, engaging their client, asking them to assess their impact and dependency on those specific ecosystems that are detrimental to fight climate change as well, and to start the conversation to assess their risk and dependency. And doing that, they will be in a much better place to integrate this externality in their decision making, and also to integrate, obviously, risk management practices, for example, and specific sectors policies, for example. So data methodology already exists, even if they are not perfect.
When I speak to anyone in the financial industry, fund managers, for example, about this, then one of their major frustrations is the problems of reporting and understanding what reporting means, and understanding and getting some consistency behind that. Gilles, is that something that is still a frustration for you, or have recent regulations and changes overcome that yet?
It depends where you are. So actually are people in our business, some of them are here today, who spend a lot of days of their life writing and poring over fairly lengthy and complicated reports for regulatory reasons, or simply because we want to communicate on these issues. But I would say that at least in Europe we have a now fairly comprehensive and fairly consistent framework in terms of reporting, and in terms of, generally speaking, in terms of how we've sorted out a sort of regulatory approach to responsible investment. It's not perfect. The sequence was definitely not perfect, in the sense that Brussels decided to start with SFDR, which is basically telling asset managers how they should classify their funds before forcing the real economy sector to report on what they were actually doing, which would have allowed the asset managers to report on what was in their funds. So the sequence was not absolutely perfect, but now that the three directives are finalized and gradually implemented, we have a fairly nice framework, which is really about the what and the how. The what is, for instance, we have a taxonomy in Europe. We've kind of defined what we think is sustainable and what is not, with some limits and caveats. And the how, we know how to market to consumers different ESG-related products. We are the only ones. It does not exist in the US in particular. And coming back to this gap between the US and Europe, here you have this sort of cultural habit, which is that the European approach, and I think in this case it was positive, it was a top-down approach. Let's get from the center, from Brussels, an ecosystem. It's not going to be perfect, it's going to be painful. You'll have people like me complaining about the regulatory burden, but you've got something. The US is evolving on a sort of natural bottom-up approach where companies do a little bit what they want, and the SEC is there to make sure that at least companies kind of do what they said they would do. It's a very different approach, and if you're a global player, that's a problem, in the sense that the methods that you define to sort out your investment strategies in Europe cannot exactly be used in the US. There is some progress in Asia, but they're also following other rules on this, and I will finish on this. What is frustrating is that if you remember the sort of general international reaction to the financial crisis of 2008, very quickly the G20 took the lead, and there was a proper coordinated push towards a level of regulation which is actually quite convergent across the main regions of the world. We still haven't done it on responsible investment. There's not the same level of coordinated and cooperative approach on this.
Maud, what would be optimal in your mind?
Yeah, I just wanted to echo what Gilles just said, and because on a positive note, there has been a lot of positive development in Asia. So now in Asia, we can see that a lot of countries are reflecting on sustainable taxonomy, green taxonomy, and even traffic light taxonomy, defining what is green, what is brown, and what needs to be financed for the transition. We are also seeing a lot of Asian countries reflecting on the disclosure of transition plan, which is also part of those enabling conditions we need, if we want to channel the investment towards sustainable activity. But it's totally true that if we want to mainstream sustainable finance, at some point we will need international forums such as the G20 to mandate international financial standard setters to set up those enabling conditions for everybody, for each and every country.
So I'd like to go back to what Olivier was saying about how this is also a problem that the funding gap is very important in the Global South. The investors, generally speaking, are in the Global North. Now, you might notice that Jean Boissineau, who was scheduled to be on the panel today, he didn't make it because he had something competing with it. But if he was here, he would say, and I know he would say it because he sent me an email saying it, that the transition will be won and lost in emerging markets and developing economies, and that investors need to think harder about how they make a difference. Now, Olivier, is closing this gap how do we motivate investments here? Do we think about it as aid?
Well, there are certain amounts that, in my view, would be easy to channel towards the climate transition in the developing world. I will take the example of the Norwegian assistance to developing countries. They have an enormous pool of money in the sovereign fund, which is created by oil. It's not their fault, they have it. They store it very wisely, but they have been discussing for years about investing into infrastructure in the developing economies. And they have not been able, at least until recently, if I miss one step, they have not been able to make a decision. They are awarding plenty of developing money. So do the Swedes as well. They have inefficiencies, they have corruption problems in their development aid programs. They would employ a lot of this money much more smartly by making sure it's channeled into projects which will provide the populations with water, clean water, and electricity. And that would do a lot towards bringing these countries in line with the climate transition. It's not the whole picture, absolutely not. So again, financing from private sector in the developed world is necessary. But again, given the seriousness of the political risk, the doubts about the competency and the fairness of the courts, you need to have a World Bank or a EIB, EBRD, a African Development Bank. You need a public body, international public body to be with you. Failing that, it's going to be minimal. But I was mentioning the situation of the Gulf countries. Mm-hmm. Where do we put them? Do we put them in the West or do we put them in the developing world? What is sure is they have accumulated enormous amounts of money and they are deploying part of it very smartly. They are the winners of the last drops of the oil that will be extracted and sold, but they're also going to be the winners of solar energy. They have a fantastic geographic situation for that, and they are investing massively on that.
So they've made a lot of the money from pumping oil, and they continue to pump oil. Is that something that you're prepared to say, okay, that's fine if it helps a transition? At what level do we say, let's stop investing in that?
No, I mean, it's not a moral judgment there. It's just the fact that the economy is not ready to go without oil today. And I think we are very unfair when we say banks, of course, the financial sector, it's so easy to hate it. It's responsible for everything that goes wrong in the world by definition. But the banks and other private sector entities and the corporates themselves, the oil companies, they do investments. Yes, they do, and they need to, because if you do not do maintenance investments, your oil well goes dry in 5 years, or almost dry in 5 years. It takes 18 months for fracking, but for traditional oil exploration, it's a matter of a few years. So are we ready for a world without oil in 5 years? No. So what we want to see is a decline in the investment in oil and a decline in the production. But it's unfair to just say that goes against the transition, that there are still some investment in the oil and gas energies. And when we get to the real world, in the bad geopolitical situation that we are in, it's not possible to do the best immediately.
Kathleen?
Yeah, I attended this presentation by TotalEnergies of their scenarios for the future. And what is perfectly clear is that in these scenarios, the increase in demand is absolutely not compatible with the 1.5 or 2 degrees Celsius, meaning that they do not believe that climate policy at the world level is going to do the job okay, so they base their investments and they base their exploration expenditures on this type of scenarios. So it's a bit of a problem, I would say.
Gilles, what do you think about this? Should we, basically at what level should we pursue extraction of fossil fuels?
I will answer this very directly, but before that, just a word on the idea that the war will be lost or won in emerging countries. It's true if you look at scope 1 and 2. Absolutely true. If you look at current emissions per head, if the entire world had the carbon intensity of France, we would not be having much of a problem. The problem is the carbon intensity in countries such as China and the fact that they are not reducing their carbon intensity fast enough. That's fine. Okay. But the risk with this sort of approach is that it may create in public opinion in the West the idea that, okay, we've done our bit and the issue is actually in the emerging countries. And this is hypocritical, because if you look at France, for instance, which is one of the greenest countries on Earth, our imported carbon emissions, which do not count towards our ranking, stand for about 50% of our emissions. So we're farmed out to some extent carbon emissions to the rest of the world, including to the emerging nations. So we have to be aware of this as not to create this sort of resentment against developing nations, which could be born. Now, fossil fuel, yes, it's a very charged issue. I think there are two metrics we could use actually to be granular on investing in fossil fuel companies. One metric would simply be, are they effectively using the proceeds of their fossil fuel production to advance on renewables? And that is something that is fairly easy to check, and you can look at how companies actually divert or not a substantial part of their income towards investing in renewables. So that's one metric, if you don't think that you should exit from the entirety of the industry. The other metric is how you extract oil, because there are many, many ways to extract oil. And actually, I remember that Fanny, who was one of your colleagues at APSE before moving to Aix, I think, put out a very interesting paper 2 years ago, looking at basically the pollution of each and single oil well in the world. Mm-hmm. And the distribution is extraordinarily wide. You've got extraordinarily dirty oil well, and some which are actually much less damaging. So you probably want to skew oil production towards the wells which, for instance, produce little methane, because methane is one of the worst byproducts of fossil fuel extraction. So, yes, it's a bit subtle. Lots of people probably want sort of black and white answer to this question. I don't think we can in the current state of the energy mix at the world level, but there is now enough data, enough information, I think, to make those granular decisions.
Maud, can I get your opinion on this, and then I'll ask the audience for some questions?
Yeah, sure. Well, my opinion is that we have the International Agency of the Energy stating that we need to no new investment in fossil fuel extraction if we want to meet our net zero target. But they are also saying that it should be implemented effectively with a global coordination between different countries, and also fairly, meaning that, developed countries should lead by example first, obviously, and emerging countries should do this progressively. Yeah.
Okay, thank you. Thank our panel, and we will clear the stage.